back to this very special edition of Indianomics, the first in 2025, where we presented you a poll of how the macros and growth and inflation will pan out. And we have our experts, Upasna Bhardwaj of Kotak Mahindra Bank, Kaushik Das of Deutsche Bank, both economists, and the head of Global Treasury at ICICI Bank, B Prasanna. Gentlemen, and Upasna, thank you very much for waiting on. Upasna, if you can, map out the global headwinds, would you think that export growth and current account deficit could be problems in FY26?
Latha, I think, at this point in time, one of the biggest, I would say, tailwinds to begin with is crude oil prices.
Okay.
Despite the risk premium on geopolitics or any other such kind of issue, we haven't really seen too much of an upside coming to the oil prices. And if at all, there is downside going ahead. So I think that is one thing which is structurally holding up current account very well. That is the other important aspect to keep in mind is the services trade surplus, services surplus that we are seeing, which is also expected to hold up quite well. On a monthly basis, we are seeing $17.5 billion of surplus, which is extremely good. That too is supportive of current account, overall current account balance. Of course, on the other side is the overall trade balance, wherein we know that there is some kind of an uncertainty to the gold imports. And that is something which we are looking for revisions, whatever happens. Once that is corrected, probably it is not going to be looking as, as alarming as the numbers that we've seen in the last 2 months.
Okay.
So this needs to be, the overall trade numbers needs to be seen with a pinch of salt. But of course, overall, I would say about 1.5% of GDP as current account deficit is not too much of a worry.
Okay.
With a slight amount of export slowdown already priced in as per our expectations.
Got it.
We're not that worried at this point on the current account. Of course, like Prasanna had said, we are more worried on the capital account side and hence balance of payment. I think that is where the bigger uncertainty would be. So when we're talking about global headwinds, then of course it boils down to the economic and the trade policies of Trump. And how the retaliation would be, with China and overall implications coming from there. So the capital outflow is where we assign a bigger risk.
I get that. And I take your point that the least worry perhaps for the policymakers is the current account deficit. I mean, we've seen 2.5% for decades. And therefore, a 1.2% of GDP current account deficit is really the least of the bother. I take your point entirely. I wouldn't worry about rupee and current account deficit, but I would worry about domestic liquidity. Prasanna, do you think that the liquidity hump is behind? Deposit rates, have they peaked at all? The Reserve Bank could be in a position of having to tighten liquidity because of external factors, sale of dollars, etc. So just map out, can we expect good credit growth this year? Can we expect lower cost of capital?
So I think, Latha, the ball is going to be completely in the hands of the Reserve Bank when it comes to giving enough liquidity in the banking system. And the reason I say that is also because of the fact that they have been intervening in the forex market. You all know that there is literally a $50 billion intervention that has happened that has actually sucked out liquidity. And on top of that, if you look at this year, they have also redeemed bonds which they were holding on the balance sheet, which has also led to reduction. Now, the CRR reduction that they did led to an addition of liquidity of close to 1.25 trillion. But that is hardly, even offset the kind of deficiency in the liquidity that has happened over the last 1 or 2 months. So I think that more than the rate cut, the Reserve Bank has to be more proactive going forward in infusing liquidity into the banking system. Bear in mind that last time when we had a system liquidity deficit, the RBI was in a stance which was withdrawal of accommodation. But this time around, they are into a neutral stance and they are possibly going into a easing stance in February, in which case they need to infuse liquidity and see the banking system liquidity to be at least neutral, if not positive. So from that perspective, I do think that, and also bear in mind that the last 3 months of this financial year, or the next 3 months rather, are typically seasonal times when your currency leakage is the highest. So from all perspectives, we are looking at a tight liquidity situation.
OMO,
but the saving grace is
OMO purchases?
So I think there is a limitation up to which the RBI can do CRR cuts. I think what RBI is right now doing is being much more proactive in providing short-term VRR kind of liquidity to the banking system. But that does not do a lot to influence the behavior of the banking system, because all you're getting is 3-day money or 14-day money from the Reserve Bank. What you need to do is to do a little bit more core liquidity into the system. So I think open market purchases is something that we expect that RBI will be more active, have to do going forward, especially if FPI sell-off continues the way it has been continuing.
Yeah, they perhaps could not do it now, because between 6.5 and 6.7 10-year, if you start doing OMO purchases, you will have such a flat curve. But maybe after the rate cut, they will have a little more elbow room to do OMO purchases. Very quickly, out of time. But Kaushik, it does look, you have that 6.5% forecast for next year. Again, you are somewhat higher on the street. Wouldn't you worry that the fiscal deficit is headed to coming down? So the kind of fiscal help is less, global headwinds are more, Reserve Bank's elbow room is lessened by the global pressures. Where is the optimism for growth coming for next year?
So as I mentioned, Latha, 6.5% growth is not good in India's own.
I agree. It's still better than the others.
It's better than the others, and we were used to 7% plus, and we are at 6.5%. But compared to the other countries, we look much better. So that is one reason to feel good about the India's growth trajectory. But the point is, in that 6.5% growth, I've already built in the 50 to 75 basis points rate cut for the current fiscal year that is coming. I think the question that you asked about liquidity, at some point, I think RBI will let liquidity become more flush in the next fiscal year, so that the short-term rates can actually fall to the SDF, and you'll have an effective easing of 75 basis points. I don't think RBI will want to cut repo rate more than 50 basis points, but they can easily have an effective easing by bringing in more liquidity. And OMO purchases are not just in terms of liquidity needs. You also need to bear in mind that next fiscal year, the supply, the gross borrowing would be much higher than what we had this year. And compared to that, on the demand side, you'll not have the bond index inclusion related money. So probably there would be a need for doing OMO purchases to ensure that yields do not move up too much, particularly when RBI is cutting interest rates. So from both liquidity standpoint, as well as the need for the demand supply balance of bonds remaining more or less, in balance, you would probably see OMO purchases coming through, but RBI will take the call when to do that, the timing, and how it can have the biggest bang for the buck. But I think February is a good time for RBI to start cutting rates, and then that will build into expectation of future rate cuts, and that itself can help growth. We are also seeing real estate sector to some extent slowing down, so a little bit of rate cut can give some boost. On fiscal, we are very clear that the government will continue with fiscal consolidation. We are looking at a fiscal deficit of 4.5 or slightly below that. So you'll not get that much fiscal impulse to growth. So monetary policy has to do the heavy lifting, in my view, to support a 6.5% growth next year.
Okay. Thank you, gentlemen, and Upasna, for giving us just whetting our appetite on the kind of growth optimism and pessimism that we will face in the coming year. A lot depends on the budget, but I'll take a rain check from all of you and invite you again before the budget to check whether, like the, the DOGE of the US, the government of India is also able to do some regulatory cutting off of, red tape, so that there are other kind of reforms that we can expect from the budget to push up the economy. Thank you very much for the maiden edition of Indianomics in 2025.